Hello, and welcome to the Tax Advisor and Business Coach Success Weekly podcast. The purpose of these episodes is to help entrepreneurs to become more successful and avoid tax headaches. I am your host, Liz Soria, and I specialize in tax advisory and business coaching. Let's get started with episode number 8. Tax savings with retirement accounts. A great topic and worth spending a couple minutes discussing. A lot of people think that tax breaks are only usually for the rich, and there are some that were made for, more of a medium class. And it is true that some breaks do phase out in the higher income levels. And that's because really, it was designed by Congress to help poor people get by. But yet many can be claimed by earners with into the six figures. Every penny counts. So what's the big deal about doing contribution into your retirement account? Don't just put the minimum required. I always tell that to my clients. You want to get a matching contribution. Okay? So even if they're only giving you 2%, 3%, 5%, still that's free money in your account by your employer. Okay? Now remember, this is a pre-tax. So this is helping you reduce your tax liability while you can save for the future. Okay? So what that means is that when they're doing a matching contribution from your employer into your 401k or 403, if you can afford to put the most the law will allow you, which is set actually in 2017 as we're recording this podcast, it's set at $18,000. Okay, now those are for anyone who's under the age of 49. Now, if you're over the age of 50, then suddenly you have what we call the catch-up provision, which is an additional $6,000, making up to 24. Okay, believe it or not, that matters a lot. Okay, often people in the 50s are really in the higher earning years. Often too, they have put up savings enough to finance their retirement. Why? Because whether you've been married and have children, or perhaps you're helping your grandchildren, or maybe you help other family members, and sometimes people forget to put their money on the side and save for retirement. And while we will hopefully still have a social security if we do, as we know, the news on the media has not been very positive in the last couple of years. It is our responsibility to save money and hopefully live a more comfortable life in retirement. We definitely don't want to find ourselves working until we're 80 years old or 90, because we cannot support ourselves, and Social Security income, it's low. So it's very difficult to be able to have monthly recurring expenses in trying to live just on Social Security. And I say this because I do help out some, retired people that unfortunately due to health condition, they can no longer work. So they have to depend 100% on just that Social Security check. And it can be very difficult. Not only due to inflation, life is increasing and it's becoming more expensive. But if you have not been able to not even purchase a property and hopefully pay less than what a rental would pay for the monthly expense, you can find yourself in a predicament where it can go against you, and it can be very, very difficult for a single individual to be able to, cover all their monthly expenses, right? Because we're dealing with electricity and phone, and of course maybe some insurance and out-of-pocket medical expenses. As we get older, and we haven't taken care of our health, unfortunately you will have these type of illness and other circumstances that will require you to spend money now in your health, right? So let's go back into the 401k and why, again, I went through this explanation to hopefully you can understand why it's so important that we all have to do our own savings and not only count on what the government is going to give us. Once again, hopefully, if some of us will be able to collect on, that Social Security check. So, what I like about the catch up provision is that it really allows you a good opportunity to be able to put that extra money, to have in a pre tax, not only helping you, like I said again, reducing your current income, but actually putting savings for your financial retirement, right? And that really helps. I mean, the Congress did this to really solve part of the retirement problem because they noticed that most Americans were not saving enough for their future years. Okay, so definitely if you have a 401k, 403, and you can have an employer make a match, just consider that like free money. Okay, in that's like it's a phenomenal opportunity that you shouldn't let just go by. And even if you're making a return of 3%, 5%, 8%, as long as you're doing more than what your expenses are in your 401k, then I think it's a phenomenal opportunity. But anyhow, for those of you who also have the 401k, maybe they're thinking, well, what else can I do to, help myself and maybe your family, right? It would be obviously the traditional IRA, right? Which is also pre-tax, meaning that now you save money, part of your taxes, and then when you have to withdraw those funds at the age of 70 and a half, which you probably have heard through other articles and things that you have read in the past, then at that point you're able to have that pre-tax. Then you will pay taxes, yes, as you start drawing that money. Okay, so traditional IRAs are great, especially if you're like self-employed and therefore you don't have a 401k through your employer. This is a good option to go through that. Now, the ones I really love, and I have to really emphasize this during this podcast, is that even if you have 401k traditional, even if you have a traditional IRA, I love Roth IRAs, and I really do, because a lot of people say, well, it's now that I need the help to cut down my taxes. But the reality is, we don't know how high those taxes are going to go in the future, right? And we know that the fact is that inflations are going to still going up and up and up. Chances for inflation to go down, it's very rare. So facing that reality, it's phenomenal to even have a 401k, and at the same time you can open up your own Roth IRA. It's very simple. Now in these days you can do that online. And it's great because it really avoids you from having future taxes. Okay? Because indeed, like I said, the taxes will be higher in the future. Okay? So it's a very smart tax saving move, okay? Even for self-employed people, okay? It really does help a lot. I love it because you put in contributions which are taxed as a regular income today, right? So you don't get the benefit of a reduction, but it grows tax free. And that's perfect. Tax free. Meaning that when you're ready to do your distributions, are actually tax free as well, right? So the reality is that you can also have an option, which is convert a tax deferred savings to a Roth IRA. You can do that too, okay? And what happens is a lot of time you can do what is called a rollover, right? And usually you only have about 60 days to do that, especially when you're switching from employer to employer. But the interesting thing about this is that you can roll over that money into a Roth IRA, okay, from either a traditional IRA or a qualified retirement, like we will discuss in the 401k, 401, I'm sorry, the 403, the 457 plans, and you can do that rollover, okay? And now remember that Roth IRAs do have a maximum that you can put, which is $5,500 per person. Okay. Again, you have a catch up also after the age of 50. Okay. And that's actually 6,500 that you can put. Okay. Now, one of the things and one of the strategies that I use for some of my clients, and I like to share this with this podcast, and it's one of the things is that if you have lost your job, if you start a new business, or you have any type of investments that have, has fallen due to market conditions, for an example, and the face value that you had on that investment now is less, it is a perfect time. It's a perfect time to consider the fact of converting part of that 401k or even your traditional IRA into a Roth, right? Because then you're actually having tax free in the future, even though you're going to pay now, but it's still worth it. So, once again, I hope my advice helps you to have a little bit more clarity in what the differences between these, traditional and Roth IRAs. There are restrictions with the Roth IRA. Yes, you have to hold your earnings for 5 minimum years. But the pretty thing about the Roth is that you're able to withdraw your contribution. So whatever monies you put in, actually you can actually pull that back. What you cannot touch is the earnings. So if you want to invest, let's say in stocks and bonds, right? And suddenly you have an emergency in which I hope you won't have to touch that money, but if it's a true emergency, you can pull that money out and you will not be penalized for that money because that's considered your contribution. So if you put $5,000 down, and let's say you have $500 that you have earned in interest or, through stocks and dividends and so on, that other 500 you cannot touch, not until you turn those 5 years, okay, which is really 59 and a half. Okay, you have to hold that Roth IRA for 5 years before you're eligible to start using the actual earned portion. So, anyhow, it's been a pleasure as usual. Thank you so much. Once again, this is Liz with the Tax Advisor and Biz Coach Success podcast. And please go ahead, feel free to share my link and also to, you know, share this with other neighbors and people that that can really help them. Once again, it is in our power to secure a future, not to expect that the government can do more than what they're doing at this point. So, thank you so much, and until next podcast. God bless. Bye bye.